Hello and welcome to another lecture on basic macroeconomics. It is our lecture number 11 on basic macroeconomics, and in the circular flow of income we are going to study the four sector model. First we will take a look at what the four sectors are that are included in the four sector model. Now we have already studied the three sector model and the nature of circular flow of income between household sector, government sector, and the business sector. Now, in the four sector model, we add or we incorporate one more sector, and we call it the external sector or the foreign sector or rest of the world sector. And we try to understand in the four sector model how the external sector impacts on the circular flow of income that we have already studied in the three sector model. So first of all, we need to understand what the external sector actually means. Now we know a lot of economic transactions take place between individuals and firms of a particular country. However, there are people and there are firms within a country who have got economic relations, who have got economic transactions with people and firms of other countries. People and firms of other countries. So when transaction takes place between individuals of the same country or firms of the same country, we may call it domestic transaction. And when transactions take place between individuals and firms of different countries, we may call it international transactions. So individuals and firms have economic relationships or trade relationships with what we call as rest of the world sector. That is all other individuals and firms that are not part of this very economy and that are part of actually of other countries. So similarly, we know that a particular individual, for example, or individuals in a country, one or two members of a family may be earning the livelihood, and they spend part of their income on their family members, right? And this is a general state of affairs everywhere. However, at the same time, we also know that some individuals move outside their countries. They go to other countries, earn their livelihood there, earn their income there, and send money back to the domestic countries, to their families, which is the income which is utilized by their families. So this is what we call as remittances. So remittances come from rest of the world. Remittances come from other countries where people belonging to a particular country, they work, and remittances flow to this very country. Similarly, people from other countries may be working in our country and they may be sending remittances back to their countries. So we can say they send remittances to the rest of the world sector, to the other countries. Similarly, we know that individuals in a particular country, they make investments in their own country, they build plants and build firms, etc. But some individuals, they move outside their country and make investments in other countries. So through this process, obviously money will be flowing out of the country, and then if people from other countries, they come and invest in our country, obviously money will be flowing back to our country. So the point here is that individuals in a particular country, they have a lot of different economic relationships with individuals and firms belonging to other countries, and all other countries together, we call it rest of the world sector. And it is this rest of the world sector, we call it external sector, and we may call it foreign sector. So we have three names: rest of the world sector, external sector, and foreign sector, which we use synonymously. Now, this makes clear to us what actually an external sector is, or what foreign sector is, or what rest of the world sector is. At this point, it is very important for us to understand that when money comes to a country, whether it is through trade, whether it is through remittances, or whether it is through investment or any other means, we call it inflow. We call it inflow. So there will be inflow of what we call as foreign exchange or foreign currency. Foreign exchange means foreign currency. However, when money moves out from, for example, our country to rest of the world, we call it outflow. Outflow of foreign exchange, or we can say outflow of our currency. It may be even domestic currency. So we have understood the concept of external sector or foreign sector, then the concepts of inflow and outflow. Now we need to understand at this point that there are two major types of economic transactions that take place between individuals and firms of a country with the individuals and firms of the rest of the world. One of this is foreign trade. One type of relationship is that of foreign trade. That is when export and import takes place. We call this export and import foreign trade. So this is one kind of relationship. And another kind of relationship is foreign investment. Foreign investment means that when a person or firm belonging to a particular country, they make investment in other countries, they make investment in rest of the world, and it can take two forms. Foreign investment can take two forms. One we call as foreign direct investment, where a firm or individual opens an office and manages the business by himself. Okay, so this sort of investment is called as foreign direct investment. So he's an owner, and he also manages the firm that he is operating in some other country. So this is foreign direct investment. Other type of investment is what we call as foreign institutional investment. Now that means that when you are, for example, buying the shares in the share market, so in the share market you are buying shares of a particular company, of a particular firm, so you become owner of that, partly owner of that no firm, to the extent you buy the shares of that firm, and you obviously get the benefits, and sometimes if there are losses, then losses as well. And this is one more type of investment that individuals make in rest of the world. However, apart from these two types of investments, we also have borrowing by, for example, a particular country from rest of the world. For example, borrowing can take place from other countries, or it can be from international financial institutions like World Bank and International Monetary Fund, or any other bank like Asian Development Bank. Okay, so this is one more type of economic relationship or economic interaction and transaction that takes place between between a country and rest of the world. Similarly, we have the concept of remittances that I have already introduced. So remittances, they can come from rest of the world to a particular country, and from a particular country they can move to the rest of the world. So this becomes one more source of interaction or transaction between two countries. At the same time, sometimes some countries, they get aid from other countries. They get aid, or they get what we may call as transfer payments. Sometimes there is some calamity in a particular country, then others come to the rescue of that very country. They send money to the country. So at that time, it also becomes a source of inflow for the country, inflow of foreign exchange for the country. So the point here is that we have two major types of economic interactions or transactions between a country and rest of the world, but we also have some other important transactions taking place between a country and rest of the world. Now, one point we need to be very clear about here is that if we bring in all the sorts of economic relationships, so I have talked about trade, I have talked about then investment, I talked about remittances, about borrowings, about aid, and so on and so forth. So if we bring all these dimensions together, our four sector model will become very complicated, and we will not be able to manage it properly. Therefore, what we do is that we bring simplifications to the four sector model. We have generally the case generally is that we include only trade in the four sector model, and we include that households they get remittances, and at the same time they export the manpower or labor. So we restrict our relationships with the external sector to trade only and to remittances. We do not incorporate usually the investment or the borrowing or the aid, etc. These components are not included, so that our model becomes simple. Now, it is possible, obviously, when we understand a simple model, we can think of incorporating all these elements to our four sector model subsequently, but generally the four sector model has only these two components included while incorporating the foreign sector. One important point that we need to keep in mind before we come to the fourth sector model is that when money comes to a particular country, whatever the reason for that money to come to that very country, the coming of money to a country, that is inflow of the of money of foreign exchange, it is considered as injection. Why it is considered as injection? Because we already have a circular flow of income going on between three sectors that we have already studied. For example, the strength or the value of this circular flow is $100, okay, and there is an inflow of $20 to the country. So our total circular flow will now become $120. It will now become how much? It will become $120. Therefore, inflow will be treated as injection to an economy. It is injecting more money to the circular flow of an economy. Similarly, when money flows out, when money moves out from a particular country, now at that time, if we had $100 circular flow and 20 rupees are moving out from the circular flow, obviously we are left with 80 rupees in the circular flow. That means our circular flow of income, its volume is getting reduced, and this is a case of leakage. This is a case of leakage. Now all the transactions and interactions which bring money in the circular flow will be considered as injections, and all the transactions or interactions that take money away from an economy to the rest of the world, that those will be considered as leakage factors for the economy. Now we will learn about this as we move further ahead. Now let us now come to the circular flow of income. Now first let's construct the three sector model. Now we know that household sector pays taxes to the government sector, so does the business sector pay taxes, and this is the financial flow that we are talking about. And the business sector obviously pays money through the factor market to the household sector, what we call as factor payments, and the household sector pays through the product market to the business sector, what we call as consumption expenditure. So this is our normal three sector model. Yes, we need to also include that that the government sector makes payment expenditure on the household sector through salaries plus plus transfer payments, and then it makes expenditure on the business sector because it purchases goods from the business sector, plus it provides subsidies to the business sector. So the third three sector model we have already now discussed, therefore we won't be elaborating it any further. Now, this is our three sector circular flow of income in the three sector model. Now we have to incorporate now the external sector. Now, how does external sector modify our circular flow of income that we have studied in the three sector model? Now, you need to keep in mind that we allow only this foreign trade because of the simplification that we have to bring to the four sector model that I have already talked about. So the external sector money comes to the business sector when exports take place, because when exports are made by the business sector, obviously it receives payment, it receives money for selling goods and services to the external sector. So money comes into the circular flow of an economy through the business sector. At the same another inflow case will be the remittances. So remittances will come from the external sector to the household sector. However, there is a case of outflow as well, when the business sector it imports goods and services from the rest of the world. Obviously it has to make payment, and the money will flow from business sector to the external sector, and from household sector it will be the export of manpower to the rest of the world sector or external sector. So these interactions between external sector and business sector and household sector complete our four sector model, and now we can comprehend through this simple four sector model how the external sector make its impact on the circular flow of income that we have already studied in the three sector model. Now let's summarize its impact now on the circular flow of income in this chart. Now we have seen that money will come from external sector when a business sector makes exports. So it will be an inflow. It will be an inflow when we are exporting. So it will be an inflow, and an inflow will increase the circular flow of income for an economy. It is but obvious, and money will flow from the external sector to the household sector because remittances come to the household sector, and therefore it is also a case of inflow. And obviously both these inflows serve as injections, so they become injections and they have the potential to increase the circular flow of income. However, there is one source of leakage, that is when the business sector brings imports and it has to make payment, and that very money will flow from the business sector to the external sector. And when there is outflow, that will present a case of leakage that we have, or the case of withdrawal that we have already discussed. And yes, we have the third is export of manpower that will not disturb our circular flow of income. But these are the three potential factors that will modify our circular flow of income when rest of the world is interacting with a particular economy. Now we had to focus on, obviously the trade is the main factor that has the potential to impact on the circular flow of income. Now we need to be conversant with the concept of trade balance and how the trade balance will impact the circular flow of income under different situations. Now what is trade balance? Trade balance is actually, it is equal to exports minus imports. Now we are already conversant that exports serve as injections and imports serve as leakages, and the reason we have already understood about this. So for example, if for example we have 100 dollars exports and then we have $80 imports, then our trade balance will be 20. So it's a positive 20. So we are having a trade surplus actually. So when we have trade surplus, our injections are greater than our leakages, and it will have a positive impact on the circular flow of income. On the other hand, if our exports are 100 and our imports are 120, so our trade balance will be negative, it will be minus 20. And in this case, when there's trade deficit, it is not trade surplus, it's trade deficit. At that time, our injections are less than our leakages, and obvious impact is going to be reduction in the volume of the circular flow of income. Now, if the case is there is neither surplus nor deficit, that is, we have, for example, 100 is export and 100 import, then obviously no surplus. So at that time, we will be having a very neutral type of a position, neither increase nor decrease in the circular flow of income. So from this analysis, we have understood what the impact of the trade balance is going to be on the circular flow of income. And if it is positive, then the injections are predominant. If it is negative, then the leakages are predominant. And if it is in balance, then there will be no impact. Now, to conclude the session, we need to keep in mind that there are various sources of inflows and outflows, and we know inflows will serve as injections and outflows as leakages. So if remittances are coming from outside to our country, then that means it will be a case of inflow, and it will serve as an injection. Circular flow of income will increase. And if it is moving out to the rest of the world, it will serve as a leakage rather than injection. Similarly, another source of inflow can be what we call as transfer payment or aid, and again, if it is coming in the country, it will serve as injection. If your country gives aid to some other country, then it will serve as a leakage. Now, foreign investment, again, if it is coming in the country, injection. If it is moving out from the country, then it is a leakage case. And obviously borrowing, if a country is borrowing, then it will be a case of injection. Whatever the cause of the inflow is important, it will serve as an injection. And if a country is lending, then it will serve as a leakage. Now, if you can include here trade here, if exports are predominant, so it's exports and it's imports. If exports are predominant, then it will be a case of inflows. If the imports are predominant, then it will be a case of leakages. So I hope that you have kept in mind all these things. And the final point that we need to keep in mind is the concept of balance of payments. Now, what is the balance of payments? The balance of payments is that money flows in a country and money flows out of a country, right? Now, the balance between inflow and outflow, the summary of this inflow and outflow of when this foreign exchange is what we call as balance of payment. So balance of payment is a summary statement of all the transactions that take place between individuals and firms and governments of a country with the rest of the world, their individuals, their governments, and their firms. So we can say that it is a statement of all transactions made between entities in one country and rest of the world. So this is one important concept that you have to deal with as you study the external sector and the way it interacts with the domestic economy. I hope that you have understood the four sector model quite nicely. Do subscribe to my YouTube channel, Macroeconomics. Thank you very much.